So let's take a look here at the liquidity of your bond investment. Very similar to CDs, except for the fact that unlike CDs, they can be converted to cash prior to maturity. So you don't have the situation like you do with a CD where there's an early redemption penalty or anything like that. We can convert our bonds to CDs, our bonds to cash if we need the money in various ways. One way that comes up is through a call feature. What happens in this situation is the issuer has an arrangement from the beginning that says that at such and such a date, if I want, I can call this investment away from you at a designated price. So, for example, on our GE bond here that's issuing today, GE might have the right on February 28th of 2014 to call that bond away from us at and pay us $100,000 for that bond. That would be an example of a call feature. Point out to you here that call features are really not advantageous from the investor's standpoint, and the reason for that is that if the bond rate is too high, the issuer is going to call that bond away from you. So, for example, you get this GE bond at 2%, and next year the market rate's down to 1%. Well, GE is going to call this away from you next year and then reissue at 1%. So this can be taken away from you against your will. On the other hand, if interest rates spike and if rates go up to 5%, what do you think is going to happen when this call opportunity comes along? GE isn't going to exercise it because if they called in your investment, they'd have to turn around and reissue it at 5%. So they hold all the cards in that situation. It's really disadvantageous from the investor standpoint. But that's sometimes how an investment can be converted to cash, is through the exercise of a call feature. Another thing that can happen is there can be a redemption offer, and we've seen an unprecedented level of activity in this regard right now. In other words, there's no obligation for you to sell your investment back to the issuer, but the issuer will come along and say, hey, I'd like to buy this bond from you, and here's the terms on which I'd like to do it. We see 2, 3, 4 of these a week here lately. What the companies are trying to do is they're trying to buy their bonds back and turn around and reissue them at lower rates to restructure their debt at lower rates. So these aren't bad because you have an ability to say, no, I don't want to do it. I'm not happy with that price. But that's another way that you can convert your bond to cash. And then a third and very common way, of course, of converting the bond to cash is through a secondary market sale. Just like you can sell stocks and those types of investments out in the secondary market, you can do the same thing with your bonds to convert it to cash.